Well, a very good afternoon to you, ladies and gentlemen across Eastern Africa, and hope you're all having yourselves a very wonderful day as you begin this beautiful month of June. Now, my name is Gabriel Achaye, and it's my profound honor to stand in for our able chairperson, Miss Lena Onyango, who will be joining us a little later on. And this afternoon, I am happy on behalf of the East Africa Law Society to welcome you all to this wonderful webinar session. And our webinar this afternoon is talking nothing but finance bills 2026-2027. And today we are examining the implications for tax, business, and legal practice in East Africa. And as you may know, the East Africa Law Society remains very committed to providing timely, practical platforms through which you, our members, can engage with emerging legal, regulatory, and policy developments affecting our region. And this afternoon's webinar is a huge part of that commitment. Now, as you know, every year, friends, finance bills often introduce new changes that influence how governments raise revenue, how businesses structure their operations, and how legal and tax professionals advise their clients. However, the 2026-2027 finance bills are particularly significant because they reflect a broader shift in tax policy across Eastern Africa. Our governments throughout the region are increasingly focusing on digital economy, cross-border taxation, tax compliance, revenue mobilization, and the use of technology-driven enforcement mechanisms. Now, at the same time, something interesting is happening, friends. Businesses are operating in a rapidly evolving environment characterized by digital payments, regional trade, remote service delivery, and growing through regulatory scrutiny. For legal practitioners, of course, this development presents both opportunities and challenges. In Luganda, we say, amaziga gente gesanyuliembwa. The cry of a cow is the joy of a dog because at the end of the day, it gets some food out of it. So, as legal practitioners, there are both opportunities and challenges that we face. And our clients are no longer seeking advice on how or what the law says, but they want practical guidance on compliance, risk management, dispute avoidance, transaction structuring, and navigating increasingly sophisticated revenue authorities. These implications extend far beyond tax departments. The new measures that we've seen affect startups, multinational corporations, financial institutions, telecommunication companies, professional service firms, investors, and ordinary businesses engaged in cross-border trade throughout Eastern Africa. Now, this session will move us beyond a simple review of legislative amendments, and our objective this afternoon is to unpack the practical implications of these reforms, identify emerging risks and opportunities, and equip us all with the skills that we need going forward. Now, with me this afternoon is an esteemed panel of speakers who are both from government, private practice, leading advisory firms, and different jurisdictions across the region. In particular, I would like to welcome for the first time the Republic of Somalia to this conversation, represented by our very able speaker, Dr. Abdi Wahid Osman Haj, whom I will introduce later on as he comes to make his presentation. Now, to you, our participants, I encourage you to engage actively. Please throw those questions. We are all hungry and eager to learn. Now, with that, friends, let's begin our session by setting stage in today's discussion. And we'll be having a presentation or a discussion on the most significant development in the modern taxation landscape, which is the taxation of digital economy. Now, like I said earlier on, across East Africa, governments are increasingly seeking to capture revenue from digital transactions, online platforms, remote service providers, and technology enabled models. Yet these remain one of the most dynamic and technologically complex areas of tax policy. To guide us through this important subject is a man whom I have grown to respect in terms of his acumen in taxation and policy. This man is a tax policy specialist at Uganda's Ministry of Finance and Planning and Economic Development. He has over 11 years of experience in taxation, tax administration, and fiscal policy. He's also a part-time tutor at the Uganda Revenue Authority Tax Academy and the SRB Taxation Institute, and serves as a research fellow at Mawazo Tax Policy Research Center. Prior to joining the Ministry of Finance, he served as manager of taxation at the Grand Thornton, Uganda, where he spent 7 years, and he spent 7 years at the Uganda Revenue Authority, including within the Rulings and Interpretations Unit under the Business Policy Division. He's a respected researcher. He's an author whose work has appeared to be leading regional and international publications focusing on taxation and fiscal policy. Today, friends, that gentleman will speak on taxing the digital economy, and he'll help us understand the new withholding tax and digital services tax rules. Friends, that gentleman is none other than Mr. Solomon Rukundo. Solomon, a very good afternoon. I hope you are doing quite well in Kampala, where you are. It's an honor to host you this afternoon and to hear your perspectives on the digital economy and taxation. Over to you, sir.
Thank you very much, Gabriel, and good afternoon to you all. Indeed, I'm very well here in Kampala. Given that we have 15 minutes or so, I'll get right into it. I do have a small presentation I'll be sharing. I hope you can all see it. So my topic is the taxation of the digital economy, understanding the new withholding and digital services tax rules in East Africa. The first thing to appreciate is the challenges in taxation of the digital economy. So there are a number of challenges. Some are policy, some are administrative. The first policy challenge is the traditional international tax and cross-border VAT envisaged physical business premises and business-to-business transactions. And yet now there's a rise of business-to-consumer transactions. So the traditional international tax rules, these ones are with regards to the income tax. When issues like permanent establishment come up, when you look at the rules of permanent establishment, they were looking at some kind of actual physical presence. And with the VAT, it envisaged largely a business-to-business scenario. Same thing with income tax, really. That is that it is a business in Uganda or in a business in Kenya, a business in Somalia that is going to do business with Microsoft in the US or any other entity in whichever other jurisdiction. So with business to business, those are easier to track. Why? Because the business in Uganda, in Kenya, in Somalia, in Tanzania, that business is going to have to account for the expenses it has incurred. It's going to have its bank accounts, which could be and could be subjected to an audit. And so it has an incentive to actually comply. And so if it is about a withholding tax, there is a high chance that it will actually withhold when it makes a payment for the business it has consumed. So business to business transactions have a higher chance of traceability and a higher chance of detection. But now with the rise of business to consumer, and here we're looking at things like Netflix, whereby it's a final consumer who is going to get services from Netflix. That becomes very difficult because the final consumer is going to make their $10 payment to Netflix, and that's the end of it. So you now have the risk of Netflix getting income from Uganda, from Kenya, from Tanzania, and not accounting for that income. So therein lies the one of these policy challenges. Then you have the challenge of profit allocation. And this is a challenge with differing digital models. So the profit allocation rule is an international tax rule that you're going to allocate profit where the value is being created. Now, value creation is tricky when it comes to digital services. For example, look at Facebook. Facebook generates some value simply by the fact that maybe 3 million Ugandans are using Facebook. That creates a value for Facebook, but there is no direct payment. There is no direct link of payment moving from Uganda to Facebook, Ireland, or wherever else it may be located. And so the value, you can have a separation of value creation and the actual payment. So for example, Coca-Cola in Atlanta in the US may pay Facebook in Ireland because there are 3 million Ugandans using Facebook. The 3 million Ugandans may be the incentive for Coca-Cola to make the payment. So you have a separation of money from where the value is being created. So digital economies, the digital economy model creates this disruption that makes it difficult for one to apply the traditional international tax rules. Then there's also the disruption. The disruption caused here is the move from physical to digital. And why it's disruptive is that you may have fewer buildings being occupied, which means rental income, which one was traditionally earning, they may not be able to earn. They move from traditional telecommunication, things like phone calls, texting. If that's where you are applying excise duty, you will not be able to get that excise duty anymore. And so those kind of disruptions are coming up. And we have the administrative challenge of traceability. Traceability in different forms. People may be simply transacting on social media. Someone has no shop, they simply have their wares in their home and they start selling goods via Facebook, via WhatsApp. And so these become challenges that will make it difficult for the traditional tax system to work. So we're going to look at the new proposals in the finance bills. And here I'm looking at the finance bills of two countries, Kenya and in Uganda, we don't use the finance bills, but we use the specific tax statute amendment. So for income tax, it's the income tax amendment. But we are looking at, in looking at them, I'm looking at, this is a useful background that because we need to understand what are they trying to cure? What is the general disruption, the general challenge, the general mischief that they're trying to cure? And this is what they're trying to look at. So in Kenya, we have a proposed amendment on management fees. And this is relevant because the management fee will be subject to the withholding tax. And the amendment in the finance bill is amending the Section 2 of the Income Tax Act to include interchange fees and merchant service fees arising from transactions that use cards as a means of payment. So, credit card payments, the interchange fees involved there. So this will widen the base of payments by including expanding the definition of management fees to include interchange fees. But it will, in particular, it will include digital fintech, banking, and payment ecosystems will now be captured. But this is really significant because it overturns a decision of well, no, I shouldn't say overturns. I should rather say it departs, perhaps I would say departs from, because overturning may have, constitutional implications for the lawyers. No, it is more of a sort of departure. In this case, the Supreme Court of Kenya had held that interchange fees are not management fees. They do not fit within the definition of management fees. And so, because KRA had attempted to assess and to collect the fees. So having lost the case in the Supreme Court, the law is now being amended to capture the position that KRA had adopted in that case, which is that interchange fees would be subjected to the withholding. So in this case, of course, the management fees are now being expanded to capture that. We also have an amendment to the definition of royalty. And we'll see this is relevant to Uganda as well. It's quite interesting that Kenya and Uganda seem to be facing the exact same challenge, which suggests perhaps when the other finance bills of the other East African countries come out, you find that they are probably facing similar issues and moving in lockstep. So there is a proposal to replace the definition of royalty with a more expansive definition, which is going to include software, the right to use, copyright, literally, artistic. These are traditional definitions of royalty, but now it's being expanded to include any software, whether it's proprietary or the shelf, whether in the form of a license, development, training, maintenance, or support fees. So basically, any fee paid for a software will qualify as a royalty, and that will mean subjecting, when you're paying for that fee, if it's to a non-resident, you're subjecting it to the withholding tax regime. Also, a proprietary digital platform, any payment network, payment card, scheme, payment processing system, all these are going to be treated as royalties and therefore subjected to the withholding tax. The distribution of software, where regular payments are made for the use of the software through the distributor, are also captured as royalties. And again, that's relevant towards withholding the upon payment to a non-resident. In Kenya, they're also amending the Value Added Tax Act for commissions by digital payment service providers and making them standard rated. So this is they've been treated as exempt, or at least it was implied in the law that they would be exempt, but now they're going to be subjected to the VAT. So subject to VAT, money transfer, payments, processing, settlement, merchant acquiring, gateway services, aggregation supplied over software. So here, basically, the digital platform, where the digital platform is used for payment, is going to be subjected to VAT. And again, this is a departure from a decision of the court. This was a High Court decision, Pesapal Limited versus Commission of Domestic Taxes. When it came out, I know it caused quite a stir even here in Uganda, and we had a whole bit of discussion about it. What is interesting to note maybe is that I know many people would find it maybe odd that we're having VAT imposed on financial services, on what are traditionally looked at as financial services, but the traditional reason for not imposing VAT on financial services from the policy perspective is that it's usually very difficult to find the point of imposition, the direct point where in a financial service where VAT can be imposed. And so financial services where you can find a point of imposing the VAT, it is considered best practice that you impose it. So imposing the VAT here is not all that strange, although if you look at it now from another aspect of policy, that is from the sort of principles of VAT. But if you look at it from the aspect of policy, that you are dealing with a situation where you want these services to continue to be used more and more, then you may opt not to impose the VAT. It might not be necessarily the best practice. So it's a point that's debatable. If you want, because this is going to increase the cost. Inevitably, it's going to increase the cost, and that may discourage the use, and that may not be what you ultimately want as a government policy. So it's a debatable point. Then there's introduction of VAT or rather excise duty on virtual assets. First, there is the definition. It defines virtual assets by reference to the Virtual Assets Service Providers Act. The definitions are harmonized, what are virtual assets, as well as virtual asset service providers. And then it also imposes 10% excise duty on any transactions dealing with virtual assets. So the virtual assets here, we're looking mainly at things like cryptocurrency. And this, I know in Kenya, it's one of the areas where one of the parts of Africa where it has really been thriving. So now it's being imposed. Maybe the concerns that would come up here would be, in particular, remember one of the points I raised was when it comes to the digital economy, the challenge of traceability. So the virtual assets realm is one where you have a lot of seamless cross-border transactions. You have many people who remain buried and underground. And as we shall see, the Kenyan Tax Procedures Act recognizes that aspect, that sometimes people can even transact with even as the virtual assets, the provider, the one who is providing the services that and facilitating the transactions, detecting who those people are and getting information about them can be difficult. And so the imposing obligations can have a counterproductive result, whereby you may have the users move to those that are not easily traceable. And that can even have further consequences that were not anticipated. When people are, you have a whole economy that you are able to trace, at least because people are favoring the more popular virtual asset service providers. But if you impose taxes and these are forced to comply, then they can end up shifting towards those that are less easy to track, and that can have unanticipated consequences. So it's something to bear in mind. The Kenyan Tax Procedures Act is also being amended to cater for definitions of the virtual assets and virtual asset service providers. And it's also introducing an obligation on the virtual asset service providers to provide a mandatory annual information return, giving information of the individuals whom they are dealing with and on whose behalf they are transacting. So this will enable KRA better track virtual assets transactions. There are penalties for false information or failure to submit the information and failure to file the return. But there is relief, and this is an important position, that there is relief where the virtual asset service provider demonstrates that it made every reasonable effort to obtain the required information from the user. So it's a recognition that sometimes getting all the accurate information may not be possible for those dealing in virtual assets. There is also the cross-border automatic exchange of information with regards to virtual assets. So it's empowering KRA to enter into agreements with any other jurisdictions for automatic exchange of information with regards to virtual asset transactions. So this would enable them get the information even when one in Kenya, a resident of Kenya, is holding assets in other jurisdictions. It's helpful for traceability and would be useful. And indeed, generally around the world, this is one of the mechanisms that's been adopted, the use of automatic exchange of information to get the necessary information. In Uganda, moving away from Kenya, in Uganda, we have at least one amendment that has implications for the digital services. So in Uganda, in 2023, a digital service tax was introduced. Kenya has had a digital service tax. It moved away from that in 2024 and adopted the significant economic presence, I think at 3%. The digital service tax they had at 1.5%. There is a bit of a difference between the two. Significant economic presence is broader. You're looking at there are different thresholds used to look at the level of one's economic presence, the number of users, subscribers to a service, and that sort of thing, which creates a sort of deemed, as if it's a deemed permanent establishment. You're treated as though there's a permanent establishment when you meet those conditions. Then you have to account for the income you're earning from there. In Uganda, we use a digital service tax. So it was introduced in 2023 at a rate of 5%. So the tax is imposed on the non-resident provider of digital services. You remember the challenge I highlighted of business to consumer, that if it is business to business, you can pursue the resident business, which is consuming a service provided by a non-resident entity. So if you have Coca-Cola in Uganda, it is consuming the digital services of Microsoft in the US. Coca-Cola in Uganda has a higher chance of accounting. But when it is business to consumer, it is difficult to get the consumer here to account. The amount that they are paying is usually very low, making it not worthwhile to pursue them on individual basis. So it is easier to get the non-resident to account. Now, what we imposed here is the digital service tax at 5%, requiring the non-resident entity to account for the income they earn from Uganda at a rate of 5%. The problem was the digital service tax provision was somewhat overly broad, and software would fit within the digital service tax. Now that mean so with regards to software, it's usually going to be a business that is going to consume the software. That would mean you instead of the withholding tax, you're going to have at the traditional 15%, you're going to have the non-resident entity account at 5%, which is a reduction in revenue. So what this bill is doing is amending the definition of royalty to include software, similar to what was done in Kenya. And then going ahead to also disapply or stop apply the application of the digital service tax to software, so that software will rather or to royalty, so that software will only be taxed as a royalty, in which case it will be the withholding tax at 15% when a business entity in Uganda consumes that service. That is what I have. I hope I've set the scene properly. Gabriel, you didn't indicate if we take questions at this point or if there's even a position for questions, but that's my presentation.
Thank you so much, Solomon, for that very wonderful presentation. Friends, colleagues, if you have any burning questions that you'd like to put to our speakers this afternoon, please feel free to drop them in the Q&A segment. We'll be taking those questions a little later on. And Solomon, just to thank you for that very insightful presentation. And if I can take one thing away from your presentation, it's the fact that digital taxation is no longer, a future policy discussion. It's already here with us as a present reality of highlighted new and emerging areas that are being introduced, areas like virtual assets, cross-border exchange, and all those wonderful areas. So as business advisors and lawyers, it's something that we can take a keen look on. Now, our next speaker brings a very unique and valuable perspective from one of East Africa's youngest nations, that's the Republic of South Sudan. Our next speaker is a practice director at ALP South Sudan and a highly accomplished legal policy and transactional lawyer with extensive experience in advising clients across corporate law, banking, telecommunications, regulatory compliance, and commercial transactions. He's led complex engagements involving major telecommunication companies, financial institutions, strategic transactions, regulatory approvals, and high-value litigation. Beyond legal practice, he has contributed to policy development and legal education. Today, our speaker will help us understand the practical realities facing business and advisors operating in the Republic of South Sudan. And shout out to you if you're from South Sudan and you're joining our session. Welcome to this wonderful segment. And this is your segment where we'll be understanding South Sudan's evolving tax landscape. What are the business realities, compliance challenges, and reform priorities? And ladies and gentlemen, taking us through that session is Mr. Gift Emmanuel Luat Natalino. He's a practice director at ALP South Sudan. Gift, you are welcome, and the floor is all yours. You have about 15 minutes, and we'll take questions later. Thank you. Gift, over to you.
Thank you so much, Gabriel. If you could just confirm that you can hear me.
Yes, I do hear you, yes.
Really work. Wonderful. I just want to say thank you so much. I almost wanted to just pick it off from that high gear introduction to say that I am also privileged to today be amongst this panel of highly accomplished people to discuss issues revolving around tax and the finance bills across East Africa. Just to set the background, I have the privilege to be trained from Uganda and also bring a perspective, of what has happened in Uganda during my time while at law school. Thank you so much for that very beautiful introduction, Gabriel. Just so to continue, we'll be discussing on understanding South Sudan evolving tax landscape, the business realities, compliance challenges, and reform priorities. I think Gabriel had clearly given us a very good introduction of South Sudan being, the youngest country within East Africa. And so I take this chance as well just to set a background to let you all know that South Sudan, besides being the youngest economy, is also a landlocked economy. It means that we get to, use the ports across East Africa, Kenya, Tanzania, to be able to, facilitate trade and movement of goods from outside into South Sudan. I do acknowledge that vast of the territory in South Sudan consists of, vast lands that are not yet even developed, and so much more that can be done in terms of business, especially in the agriculture sector. Just also to add on, we depend so much more on the oil revenue, being our biggest and fast contributor to our GDP, almost about 40%. And so and other contributors as well in terms of minerals that are also being exported, not as much as the oil contributes, but also they make a significant contribution to the country's economy and the GDP. Trade-wise, Uganda has been South Sudan's biggest trade partner, almost scooping about 28% in terms of trade, and that really makes it a major trading partner for South Sudan, followed by Kenya at about 18%, and then China 23%. If you move across the markets in Juba, the capital city, you can not pass products of Uganda and Kenya and even China as well. Most of the oils that is being that's been produced in South Sudan goes to Kenya and other exports also to Singapore, making Singapore and China really the major export destinations for South Sudan. That does not rule out the fact that there are other countries that South Sudan trades with, but those really make the major trade destinations for exports for South Sudan. I will move just to discuss the institutional framework that touches and tax administration within the country, South Sudan. South Sudan, just for you to understand, is not typically as Uganda is and Kenya is in terms of its system of government. We are not absolutely unitary government. We would say we are semi, because we have the national government. The national government also under it has the state governments and then the local governments up to the grassroots levels. That simply means that they also have to be ties, so much established in terms of tax administration and revenue collections at the national level, the state level, trickling down to the local government. But nationally, the National Revenue Authority is the legally mandated body that deals with administration and collection of revenue on behalf of the national government. It is also tasked with many other duties, including registration of taxpayers, tax assessments, tracking of violations, and even enforcement of collection. One thing that maybe later we will leave it for a discussion is to ask the question over time whether the National Revenue Authority has lived to its objectives, and really grown in terms of collection of revenue, because we have seen consistently, a rise in in revenues and then a fall as well. Most recently, we were saddened to get a report from the Revenue Authority that out of almost more than 83,000 registered taxpayers, about 1,800, of them were able to timely remit their taxes to the government, which shows a huge problem that needs to be addressed in terms of, enforcing tax collections and also encouraging, taxpayers to be able to timely remit whatever is due to the government. I will also want to just state that the Revenue Authority of South Sudan is headed by the Commissioner General, and this position is, by way of presidential appointment. So I would say he is a presidential appointee and holds the statutory powers to head the National Revenue Authority, with powers to search, verify claims, and also inspect financial books and seize documentation. We haven't come across cases where all of these powers have been used effectively to be able to ensure that revenue is collected. But just like you've said, Gabriel, South Sudan is a growing country, and we live to testify in respect to the growth of this institution. Business realities. South Sudan, if you come to Juba, you realize that most of the trade is concentrated within the city center, with little in the outskirts, that is in some towns. Of course, there are major towns outside of Juba. If you go to Wau in the northern part, you go to the close border side of Arua, Yei, and then Eastern Equatoria, there are towns, but much of the trade is concentrated within the city center as the commercial hub. And maybe we can ask the question why. And because of the conflict, you realize that there is prevalent security within the city center, and so much of the businesses concentrate within Juba, South Sudan. And that also has an implication in terms of tax collection, by the National Revenue Authority. Whether the National Revenue Authority has offices in all of those places is another topic to discuss, because we may not have data to verify our assumptions. But of course, primarily you would see that some areas are very hard to access. And so that means that also in terms of tax collections may be very much problematic. We have had a very interesting trend of fiscal friction as a country. I just did a track back of how the country has been passing its financial, acts and bills into law over time. And we have seen almost consistently, most of these financial laws have been passed late. The Financial Act for 2024, 2025, for example, delayed up to November 2024. And yet the financial year of the government begins 1st of June and ends on the last day of, begin the 1st of July and ends on the last day of June, which is 30th. Like also 2025, 2026, I can tell you that up to now, the Financial Act has not been passed, the bill. It remains, as a bill, but already the financial year has ended. We are into the financial year of 2026, 2027. Very, very soon, of course. But of course, we're hoping that they'll be able to pass. If anything, they should be able to pass. But not so long from now will we get into to a different fiscal year, 2026, 2027. I was able to look at the draft financial bill for 2025, 2026, and some of the changes that it gets to introduce. The framework, that is the Public Financial Management and Accountability Act, clearly stipulates that any proposals for taxes, fees, and levies, as well as borrowings, investments, and savings are required to be presented as financial bills. And so if you look at the financial bills of the Republic of South Sudan, you should be able to see proposals for tax adjustments or levies, or any fees that are payable for provision of services by the government MDAs. And so the financial bill for 2020, 2025, 2026 introduces some few changes which I so much anticipate may not change in the 2026, 2027. If they will change, of course, they will change not by so much margin, given that in the previous year, the bill was not passed into law. And one of the things includes the rise in the exemption band for personal income tax, rising from almost 40,000 SSP, for it to be exempted from payment of personal income tax, you should be earning at least below 40,000 SSP, which is equivalent to, I don't know how much dollars, is not even, I think it should be approximately, if any, maybe $2 or something like that. Yeah, and so this is one of the things that I've noted. The rate remains 20% flat, but of course, wherever your incomes fall, the threshold should be able to allow you to either pay between 5% to 20% as your personal income tax. But personal income tax that is in respect to rental incomes remain at 20%, which has not changed over time. I've seen in the previous Financial Act, it remained 20%. And so even in the bill, it also remained. We hope that, it doesn't change. And if it changes, it doesn't change so much. I think most of the things that we have been able to, talk on, especially on the rates of the taxes, have not changed a lot from the 2024-2025 Act. The business profit tax, which is one thing that most companies, are so quick to look at, is the flat rate of 30%, which remains. And interestingly, maybe you can share from the other countries whether it is the same, but this flat rate remains equally, applicable for small, medium, and large size, businesses. So regardless of the size of the business, you are required to pay 30%, as the business profit tax for any profits that you've been able to make as a business. Gabriel, allow me to just go quickly and talk about some of our challenges in terms of compliance, and maybe before I just jump into that, now in the National Revenue Authority, quickly, apart from the CG, also has an appeals framework, judiciary review framework. If, for example, a taxpayer is disputing an assessment by the Commissioner General, then they should be able to appeal that decision to the appeals board, which is required to be, convened by the minister in charge of finance. And the Act clearly states the composition of the appeals, board. One thing that stood out exceptional, for me in the framework is the very fact that the appeals board is required to make a decision on any, a disputed item within 60 days. And so if there is no decision that is being made by the appeals board, then the Act presumes that the decision is made in the favor of the taxpayer. It's very, very interesting for us. In terms of structural reforms, policy priorities, and challenges, I would say, and I will just go back to what my colleague Solomon Lupundo had stated. I think picking up from what was stated is that so much more of these economies are shifting towards focusing on digital economy and how these states can be able to raise income from digital transactions. I think that's not the case for us at the moment. I see much of our priorities not lying within, those spectrums. Maybe because of the transitional nature of our, of our government and, and the governance structure as well. But there's no so much focus on digitalization and raising revenues from digital transactions. If you look at, for example, the taxation laws, you may not be able to actually pay unless otherwise, taxes on revenues generated from, from certain kinds of transactions, which may happen digitally because certain definitions do not capture them. One thing that we asked recently when we were looking at the cybercrime and computer misuse bill was the act which now of course is effective is the issue of how does it impact growth in technology, innovation, or things like that. But also we realized that it has an effect when it comes to tax, because if it is going to curtail, for example, innovation, it means there's a possible fall in the potential of taxes being raised out of the revenues that will be generated out of certain technologies, softwares, or transactions that may be happening online. And so to say is we have at least noted a commendable stride when it comes to investment in information technology, but that is only in respect to collection of taxes. I think most recently you have had one of the companies contracted to collect the revenues on behalf of the government, being put under the scrutiny of the US, and over some allegations, but we have seen the company, for example, inject quite a lot in terms of putting in information technology that would help in collection of taxes. But also we have witnessed a rise in tax collections over time because of the movement from cash remittances. Is moving from taxpayers into now having these transactions happen online. Our takeaways, just before I close, Gabriel, my time is fast spent, is now for lawyers and consultants or advisors that may be working or possibly advising across the country's plans within South Sudan is it's very pertinent to be to track these financial laws, especially within the country, whether at the stage of the bills or not, because they contain so much more of these revisions, either on tax rates or rates or levies that may be levied on your clients. So it is important to constantly track them, but also we also noticed that the position of the Commissioner General is, he's appointed by the president, and so there's no guarantee of tenure. And so certain times you get to receive rulings, and then a new Commissioner General comes in and it's not honored. So it is very important that tax advisors are vigilant to ensure that rulings or decisions of the board or the CG are timely and immediately enforced to ensure that they're able to settle some of those disputes. And finally, I would also say that it is very important for lawyers and also advisors within South Sudan not to shy away from focusing on the digital transactions and movement, moving into the digital transactions and how revenues can be generated, because it is a growing area. Much as right now, no much focus is made there, but it's a green area. So now it's up to any advisor to be able to focus into these areas and see how they can be able to, to make a good footing and also advise the clients in that respect. Thank you so much, Gabriel. I'll say over to you.
Thank you, Gift, for that very wonderful presentation. That is also a very stark reminder as East Africans living in this beautiful region, that whereas we do have peculiar or unique circumstances that surround our different jurisdictions, your presentation has reminded me and others listening in that while we continue to pursue a greater cause of regional integration, we each have unique jurisdictions that present very unique compliance realities that businesses and advisors such as ourselves must understand. And I love the parting shots and pieces of advice you've given us at the tail end of your presentation on what we ought to know. And sometimes it's good to know some of these intricacies as we come to engage in our respective jurisdictions. Friends, it's 3 minutes to the hour of 3, and as such, for all of you joining us, we would like to welcome you once again. If you do have a question, comment, or you wish to contribute to this discussion, please feel free to drop your comment in the chat room or ask your question in the Q&A segment of this webinar session. Those who are live on YouTube, you could as well drop your questions in the chat room, and we'll be happy to pick them on and present them to our respective panelists. Now, to further broaden our regional perspective, we now would like to turn our eyes to a unique field that many of us are looking to, and that is the Republic of Somalia, a jurisdiction whom I might dare say economic significance and commercial influence continues to grow within the Horn of Africa and the wider East African region. And our next speaker, ladies and gentlemen, is managing partner at Mogadishu Law Office and a leading legal practitioner with extensive experience in advising businesses, investors, and institutions operating within Somalia. Now, today he will provide practical insights into Somalia's evolving tax framework, emerging reforms, and realities affecting cross-border business and investment. His presentation is titled Understanding Somalia's Emerging Landscape Compliance Reform and Cross-Border Business Realities. Now, joining us from the United States of America, ladies and gentlemen, welcome with me, Dr. Abdulwahid Osman Haj. Welcome, Haj, to this platform, and welcome, friends and colleagues from Somalia. Thank you for accepting to come and share your views with us this afternoon. Bienvenue, Dr. Well, Doctor, you're muted. We cannot hear you. If you could kindly unmute, please.
I'm trying to first share my presentation, I think.
All right.
And
all right, we can see it now.
you can see my presentation, I think.
Perfectly, yes, we do see it. Yes.
Yeah. Thank you very much, Gabriel, and also good afternoon. For me, it's the early morning. Good afternoon to East Africa Law Society and to all our colleagues in the region. My name is Abdulwahid Osman Haji. I'm the founder and managing partner of Mogadishu Law Office. I have practiced in Somalia and around the world for more than 43 years. I share this 43 years experience because it shapes how I see this subject of taxation. I practiced before Somali state collapse at the Somali military regime of Ziad Barre. And then I practiced also the long years with no government Somalia. And now I'm practicing in this remarkable of time of rebuilding Somalia. And I have watched and see Somali taxi system disappear during the collapse. But today I'm watching that Somali taxi system is returning, is stronger, more modern, and far more demanding than before. At the Mogadishu Law Office, what we do is our daily work is helping international client, international organization, multinational organization is, and we guide this foreign company contractor and investors through the registration and structuring, and also we help them to obtain from the start. We explain that there is usually in Somalia and obtaining, applying, disputing the tax identification number that we never had before. It's the first time after what's called Somali new federal government that we are having in this taxi identification. And secure, we have also taxi exemption rules we had before, but this now is more sophisticated, it's more digital. And also we inform them how to manage the payroll taxi in the region with different rates and meet withholding what's called duty that fall in different award contract. So when I speak about the compliance, I describe this question that across my desk every day. It's just my everyday life that, and this is my presentation is about. Oh, okay. So, and I think in my presentation, did you see my presentation? You are on the screen. You can see my presentation. Hello? Could you see my presentation?
Doctor, yes, we can be able to.
Let me fix it. While I'm trying to fix it, my presentation on the screen. Sure. Okay. It's working. Okay. Next. See that.
Yes, Doctor, we can see you.
You can see my presentation.
Yes, we can.
Okay. Let's go now. So, in this presentation, I would like to explain Somali tax system overall, and I will cover what's. I will start from there. Yeah, because to understand Somali tax, you need to understand what is built for. We need to understand the history of Somalia and how is Somali taxation work. So what I started in trying to explain that is Somalia is not reforming all tax system. It's rebuilding when they had already before the collapse of Somalia. So, and I can see, so as you can see from the from Somalia, it's not. I can see before 1991 we had a working system, but relied entirely on custom at the port. For example, taxing people and business inland was always the harder problem because the government focused only what's it called during before 1991 custom at port. That was the main income. But when the state, when Somali government collapsed, formal taxation totally stopped for 2 decades. Revenue was raised locally, but not a national. So when we are trying, when we rebuild Somalia, began in 2012 with the federal government, the government was not preparing an old. It was choosing what kind of system to build, and the real opportunity for any country. It was just a totally difficult to build this new tax system on all the levels. So the first reform that we had, it was the Revenue Administration Law in 2019. And then we had the income tax law of 2025. The strategy for Somalia was just to rebuild an institution to match it. That's why Somali tax law is genuine, modern, and why the administration behind is growing quickly and meet the demand. The law sets the new direction and institution and move it toward to the new system. And I'm trying to fix it. This. Let me. So, under this new tax law, the Minister of the Finance is the center of the fiscal authority, is the center of the system. One framework now cover the registration and assessment and refund and clearance and custom. We have a united system. More of the work is now done by computer system, digital, everything. And instead, the officer deciding each case on its own, so two businesses in the same position are treated in the same way. The system become more consistent and it become harder to influence an outcome informally. Informal is real, and it's used. If taxpayer records do not hold up, the authority can set them aside and assess the income itself. And the assessment can be collected directly against taxpayer assets. So practical, the reality is straightforward right now with the new tax law in Somalia. Tax in Somalia is the legal obligation and is administered as a one. It's no longer something that to be settled through informal arrangement. And that's one of the biggest improvement that we have it right now in Somalia. The other thing is, there are two tax systems. The law was written in two different economic at once. So the thing is to understand about Somalia is that the most of its economy is a small trader, small business, and the smaller part is the larger formal business. One tax law has to work for both. So it was built in two tax systems. To what's the turnover, for example, for a small business, as you can see that in the way that the individual and also you can see that you can tell something about intent. It's not trying to crush the informal or force it to behave like a corporation overnight. It's trying to bring in a gentle with the rules that actually follow. Large businesses or large corporation of Somali or international are held to a different standard. And this is where the Somali looks like any modern taxi jurisdiction, like in East African countries. The law expect that, and when you receive the income, that's what the law that's what is practically is considered, and that's one of very important. For example, a small business turnover $50,000 US or less, paying each quarter the higher of $37.5 or 1.5 of sales, but only for individual, never companies. So for large taxpayer, modern machinery, accrual account, and a permanent establishment rule that can reach a foreign company without a local subsidiary. Transfer pricing establishment rule that can reach a foreign country without a local subsidiary. Transfer pricing rules without withholding duty for a payer. Alongside, we have also the new, we have the old 5% sales on import and 5% of sales tax on hotels, ticket, consumer. So also we have right now the biggest achievement of this new taxation law, that because the law of 1966 was written in Somali shilling, but for now all our taxi payment are dollarized, under dollar, is paid in dollar. So individual, for example, he has to remember that if he if he paid what's called $1,200, this is 6%. The taxi, it goes from 6%, the employment tax 6% to 11% and 80% for a company. And then also we have, so what the compliance really demanded for business is still believing that they can operate formally on legacy, on legacy of tax assessment. That era is over. Somali today, every company must obtain a taxi identification number, hold a valid taxi certificate by degree. Every licensed company, he cannot obtain a license, he cannot do any activity without the taxi clearance certificate. And that's the main thing that is this new law is introduced. The other thing is income taxi. Income taxi is paid quarterly. First installment due the end of March, June, September, and December. Those 4 periods are paid. Then file are reconciled on by 31st March. So keep record for 4 years electronic. Once you passed the $50,000 enrollment, after the $50,000 you have to pay, and that's one of the things that are very important. Somalia and the cross border, one of the deeper challenges of with the cross border and unifying the tax system is the Somali civil law country, and joining most of the country I think in East Africa community, they are largely common law community. Integrate the two systems is very difficult, and it's about changing the legal culture. For Somali, it's not easy to go from civil law to common law. The structural differences are deep. Our commercial disputes are resolved under codified mandate. For example, we have civil code, we have civil procedure, and we have the financial law based on our, and we have also company law. and all are based on the civil law system, and to a common law investor, these are not academic different. They are not academic different. The comparative lesson is, for example, as you can see, European Union, they are mixed. They are different system, and they are working still together. So the East African community, although they are from different background or different system, still we believe that it can be harmonized partially, mutual reconciliation, mutual arbitration system, and for Somali practitioners, the task is to show that how codified civil principle apply to model commerce and cross-border and common law. And if I go, what's it called, and about and we did this part. Okay. So the main core, I already explained that the main statutory application is tax identification number, tax clearance certificate, and quarterly income that the people must know that from March, June, September, and December, and file a reconcile by March. Okay, and that's one of the other major concerns. Withhold the taxing, I already explained that, and also in the 5% of sales tax. And another one of the biggest issues is fiscal federalism and state jurisdiction. That is one of the issues that right now it needs to be resolved. So Somalia is as you know, Somalia is a federation of very young. The boundary between the Somalia, the federal government may tax, and what the member state may tax is still not settled. There is discussion going on. The result is that the business operation is more than one region can sometimes face tax from more than one authority of one federal member state. So it can be sometimes in confusion, but it's a federal government. They are trying to do the task, and try to harmonize and for what's it called, the East African country client, the practical consequence is specific manageable. You cannot assume that the federal rules and the regional rules are identical. We're trying to explain our clients that you cannot assume that those are same. You confirm both in each region where the client operates. So usually, if the client is operating in Benadir Regional Administration, or is operating in Hirshabelle, or is operating in Galmudug, we're trying to explain the differentiation. Because there's a taxation, employment tax, for example, they are a little bit different, not big difference, but there's a difference. So, and the federal government, most of this have already agreed who collect what, and the settlement is not completed. It's still, and that's one of the main issues, that the federal and tax jurisdiction is still an issue that's not resolved. And the other issue is the cross-border. Somalia is so, and the first of all, a foreign company paid from Somalia for the service in general tax. The Somali pay withhold before sending the money out. Your client abroad may be taxed in Somalia without even coming to Somalia, or have a local, what's it called, subsidiary. Second, our network of tax trades is very small. There is not a lot of tax trades between East African countries still, and there is no double taxation agreement between those countries. Somalia offers protection through its own law. For example, we have one of the great law that we have, it is the Investment Protection Act of 2023, who guarantee the foreign investor equal treatment and right to move their money out protection against it, having seized their asset or access to international arbitration. The takeaway is that Somalia is open to foreign capital and has written a real protection into law, but the treaty framework you may rely on elsewhere is still not being built. Where things stand right now, let me bring to a single accurate picture and how the issue right now is. I'm trying to fix it then. Okay, I'm trying to fix it, my PowerPoint presentation. Anyway, and let me bring to a single accurate picture. In the Somalia has built a legal framework of a modern tax system, built the institution to run the system with this new law. The law that we have of 2005 income tax law is genuinely modern. The administration behind is real, is growing, and to match standard, the law said. What this means for you is that Somalia is no longer a place where tax is informal or negotiable. It's a functioning system with a clear obligation that an advisor can read, plan around a confidence system. It's still, as we know, is a maturing system. A part of it, the federal settlement and the treaty work is not completed. Knowing that which part are separate and which part still is forming exactly the value a good advisor bring. That's what we provide. What is exist, what is not exist, and what it can be, what's it called. So my message is direct. Treat Somalia as a really improving legal system. Understand it is firm where is still the development. You can serve client well. Thank you. I look forward to your questions. And also, I sent my to Gabriel, I think, my presentation. If you can share, and I had a little bit difficulty to present and to send in the screen. Share, you can share with everybody.
Yeah, certainly, Dr. Haji, I will be sharing those presentations that I have received, including the one that you have just made right now. But in summary, Dr. Haji, I would like to thank you so much for that very insightful presentation. And now we have seen Somalia's transition toward a modern tax system driven by different reforms in tax and administration. For me, the key takeaway is the fact that Somalia's tax framework continues to nurture, mature and nurture businesses and investors. And we must then place great emphasis on compliance and proper tax planning. So thank you once again, Dr. Haj. Having explored now the realities within the different jurisdictions, that being Somalia and the Republic of South Sudan. Now, we'd like to turn to an issue that concerns every business, regardless of where it operates, and that is managing risks before they become disputes. We all know for a fact that our revenue authorities, if you can tell the tone from the presentations we've just had, the revenue authorities are becoming increasingly sophisticated in their use of technology, data analytics, and third-party reporting. And as such, businesses must strengthen their compliance systems and audit preparedness. Now, to guide us through these practical realities, I'm pleased to introduce a gentleman who is a senior tax advisor at KPMG East Africa, Mr. Fahad Chizito, who brings significant experience in advising businesses on tax compliance, risk management, audits, and engagements with revenue authorities across the region. His presentation is titled Managing Tax Compliance Risks and Revenue Authority Audits, under the 2026-2027 finance bills. We don't want to miss this. Fahad, over to you. This is the gist of what we've been waiting for. Thank you, Fahad, and the floor is all yours. Thank you.
Thank you, Gabriel. I don't know whether you can confirm that you can hear me.
Yes, I can. Thank you.
Thank you for that. And also to thank my fellow panelists that have so far presented, Dr. Haj, Solomon, and Gift Emmanuel. Thank you very much for the wonderful presentations. And also to our dear attendants for the patience and attending this session. So I say time is also not on our side, so I'll try to make my presentation a bit brief. I didn't prepare slides, but I'm going to be using my notes here to guide through some of the aspects that are touching in my presentation. Just also to let you know that I work at KPMG, which now is much of KPMG Africa, where we have a lot of offices in Africa. And now specifically, I'm attached to KPMG East Africa, where as part of our work, we keep sharing information and experiences with our colleagues across the Kenyan office, Tanzania office, and also we serve South Sudan. So we have experience in quite a number of jurisdictions in East Africa. I think it's only Somalia that we haven't really ventured into, but whatever we'll be discussing will be experiences that we have seen across the East African region, where we have provided our support. So my topic is quite a timely one and a very important one, given the fact that one, some of the East African countries have already tabled their budgets, or some are preparing to table their budgets, especially for those that have a junior end as their financial year. And then this means that now the budgets, if the budgets are approved by the national parliaments, then the chase for the money to fund these budgets have to start. Now, we also know, as a matter of fact, that in East Africa and in Africa, most of the revenue that finances public provision of services comes from tax, and then we go into borrowing, donations, among others. But we've also seen the what is happening politically, internationally, the fact that money is becoming a bit scarce. Funders are becoming a bit, picky in choosing who to fund and the projects to fund. So it increases a lot of pressure on the domestic revenue mobilization. And that comes down to the taxpayers, and all of us here are taxpayers. So my topic is going to be about how we can manage tax risks, especially for businesses. May not really be as an individual, but much of businesses. But even this could be applicable to you as an individual. We shall also look at some of the compliance mistakes that businesses make in terms of withholding tax, value-added tax, and digital transactions. But then we shall try to see how businesses can prepare themselves ahead of a tax revenue authority reviews, and also audits, among others, but also have some kind of some guidance to lawyers and advisors that may be acting on behalf of these businesses. And this is all intended to see that at least the businesses pay their fair share of taxes, and the tax authorities receive the fair share that it has to receive from the taxpayers. So we shall first look at the new compliance enforcement trends across the region. Like I've said, that there's too much pressure on tax authorities. At least from where I stand, from Uganda, the pressure is really, really, really too much. When you go to the tax revenue, when you go to the tax authority of Uganda, which is the Uganda Revenue Authority, each and every department that you go to, you find at least a whiteboard where they have written all the names of the people in that department with their respective targets for the month, for the week against them, and how they are performing. And this, they even display for even the taxpayers to see. so that then if they are really taking you on, you know that they are chasing something from you and they really need that. So as a result of this pressure, and I know it may not really be different from our brothers and sisters across the East African region, there are a lot of compliance coercive measures that tax authorities have embarked on that may impact our businesses. So some of those that I've seen personally have included actually suspending taxpayers' tax identification numbers. Of course, you know, when they suspend your tax identification number, you may not be able to file returns, let alone even process tax payments. So it becomes a very coercive measure for you now to do whatever the tax authority wants you to do, or else you fight it in courts of law, so that then you can restore your tax identification number. So that's one of the measures that we have seen that are coming up as trends across the East African region. There are some others like revocation of withholding tax exemption status. And interestingly, even in Uganda, withholding tax exemption has always been for 1 year for a full financial year. But starting from this financial year, we've seen that our tax authority and our Ministry of Finance have informed that this is going to be on a 6-month basis. So that means halfway the year, then they evaluate your compliance and whether you're cooperating with the tax authority to see whether they renew your exemption or not. So that is a trend that is coming up. But even before that one came up, the withholding tax exemption has always been having preconditions or conditions to it, as even they grant it, that it is subject to your compliance, which means that should you be non-compliant at some point, then that can be revoked and it can impact your cash flows in the business. And it has impacted a lot of our clients. And for some, we have advised here and there, and they have gotten restored. But it's a trend that we have seen coming up across the East African region. There are some others like the very, very painful ones, issuance of agency notices, where now the tax authorities issue agency notices against your monies in the bank. And then, you know, in our laws, when they issue an agency notice, the bank has no option but to comply with that agency notice. And agency notice means that when you have some liabilities, could be a ledger liability or an assessment or a return liability, the tax authority writes to your bank and requests the bank to transfer that money, to transfer the money amounting to that liability to the tax authority's account. So when that is issued, the bank has to comply. And it doesn't really even matter the kind of relationship that you have with your bank, because should the bank now not remit that money within the time that is given by the tax authority, then they become liable for that obligation. So to save their faces also, and also their relationship with the tax authority, then they have to comply with that. And that is happening across the region, among other measures like closure of shops and businesses, among others, to ensure that taxpayers remain compliant. So those are some of the few. There are quite many, but because of our time, we cannot really go much into them. I just want to say that I touch on each and everything that I have to touch on in my presentation, but those are just a few of the many that are happening across the East African region. The other aspect that I would like to talk about is about the common compliance mistakes for businesses, and this may be cutting across with the holding tax, VAT, and the digital transactions. And of course, if you can guard against this, then you can certainly at least minimize the kind of exposures that you can have to be subjected to some of the very coercive measures that I discussed earlier on. Some of them, maybe to start with the holding tax. We've realized that many businesses negotiate contracts that are called net contracts. And by net contract, I mean contracts where someone says, especially, and this happens with foreign service providers and foreign providers of a certain maybe services and licenses, where they negotiate and say, for me, I want maybe $100,000 as my payment. So I don't really want to know about the withholding tax that you're going to charge. I want 100,000. So if now you book that amount of money in your books and you're basing on that to make a declaration to the tax authority, should it come out that you actually negotiated that net contract, then the tax authority is going to gross up that amount, hence exposing you to quite a lot of liabilities in principle, penalties, and interest for the unpaid tax. So that is one of the mistakes we've realized. Also, we've seen that for the holding taxes still, businesses transact with people, and sometimes they rely on withholding tax exemption certificates. But remember that the tax authorities always, depending on the compliance of a business and a taxpayer, they always update the withholding tax exemption status of taxpayers. So I can't be exempted today, and if you're dealing with me, you don't have to subject my payment to withholding tax. But again, maybe the next day, the tax authority revokes that. And at least for Uganda, there is always a live list on the Uganda Revenue Authority website where you can always check and see the tax status, the withholding tax status of a taxpayer. So if you're dealing with me and you don't really check on that very day to see whether my exemption is still valid, then you are going to pay me without deducting withholding tax, but then you cannot tell the tax authority that I based on the certificate, because then they will point to the website where they always update this, let alone even the certificate saying that this status may change depending on the compliance of a person. And you know, when you don't subject a payment to the withholding tax, you become personally liable. So that has been quite a pain point for many of the taxpayers from our experience. The other one is about transactions with suppliers that are resident in countries that have double taxation agreements. So across the East African region, you'll find that the countries in the East African region have double taxation agreements with other countries. I think one of them is Netherlands, then the UK, among others. So when you're transacting with people from those, then some of those have reduced withholding tax rates, but then those are subject to proof of certain conditions. Some could be beneficial ownership, and then sometimes even economic substance. So it's upon you who is paying that person to ensure that the person meets those qualifications before you subject their payment to a reduced withholding tax rate, with some even being exempted from tax. So if you do not really check for that and subject to the payment to withholding tax rate, then you will personally become liable, or the business becomes liable for the difference between the reduced rate and the rate at which they should have withheld, if at all the person had not been taken to be qualifying for the reduced rate. So that's also one of the mistakes that we have seen. The other one is failure to reconcile with the withholding tax and VAT declarations. You see, for example, you pay someone 1 million USD, a foreign service provider, and then you have to withhold on that payment. But then because you're getting an imported service, you have also to charge withholding tax on that. Sorry, VAT on imported services, or what we may call reverse VAT. So if you declare that amount for withholding tax, but then you do not declare it for value added tax, that may cause some kind of a variance that may expose you to a lot of liabilities, depending on where the liability is coming from. If you declared it in withholding tax return but without VAT, then in VAT, they will charge you 18% of that amount that you paid as reverse VAT, let alone the interest that is compounding on that principal tax and penalties. If it is on the VAT side, then you have to be prepared for the 15%. So you have to ensure that your declarations are aligning in terms of VAT and withholding tax. Then from a VAT perspective, of course, that is one of the issues still. It is in the WHT, but also in the VAT, ensuring that your declarations align. If at all they touch on something that actually would attract both withholding tax and VAT. So the tax authority will always expect that both the declarations are made and there's no cheating in the tax. We've also seen that of recent, we've seen some cases, especially from Uganda and Kenya, where the issue of what amounts to an export of a service comes up because exports are zero rated. So if now something can qualify as an export of a service, an export of a good may be a bit easier, but an export of a service then becomes a bit tricky, especially if the beneficiary of the service may again be in a jurisdiction where now the tax authority feels it doesn't really amount to an export of a service. So that has caused some bit of controversy, and which has also brought in the considerations of the OECD principles on export of service, among others. It is something that also businesses have to really take keen interest in. And also compliance with the VAT taxation points. We know them taxation, because value-added tax is due either at the earliest of invoicing, if now you're the person providing a service or a good, if the person receiving, then at the point of receiving that invoice. Then also payment. Payment may even become before the invoice comes. So if you pay, then you should declare that transaction in your VAT return. But if you don't declare it, then at that point in time, then you may be charged late declaration penalties. And also points when the invoice comes in, or the payment or receipt of goods or services, or provision or supply of goods or services. So complying with the taxation points becomes a bit quite another tricky aspect and mistake that has been made by taxpayers, especially if now they are going to look at the withholding tax. Maybe you comply with the withholding tax based on payment, but again, you may have accrued that invoice and you have to declare it for VAT and you didn't. Now, we are also saying that revenue authorities, the other point of discussion was how revenue authorities are approaching audits and information requests. And to be honest, we've seen that they have become more and more aggressive. First is, I've seen in this even calendar year from January to now, I've seen quite a vast number of audits where the tax authority has audited a taxpayer for more than 7-9 years. There's even one of 10 years, especially for some taxes like transfer pricing. So whereas we have a law that says a tax authority cannot go back beyond 5 years or 3 years to raise an assessment, they have gone on to raise audit commencement notices where they are auditing a taxpayer for 7, 8, 9, and 10 years. And then this therefore means that before a period is audited, you may not really have peace of mind, because you will be rest assured that a tax authority will be coming to you at some point in time. We've also seen quite excessive information requests. They have become quite very excessive. We are also seeing that tax authorities now are not really spending a lot of time before they look into the return that you have just filed. They are using artificial intelligence to compare the return that you've just filed with another return for prior, to compare that return and another return, the VAT return and the withholding tax return. So there is a lot also of usage of artificial intelligence to inform their decisions on the risks they are identifying with you, on whether they should issue a compliance advisory audit, among others. So we are also seeing modest audits where they want to audit you for 1 year because they want to get easy wins without now telling you that we are auditing you for 4 years, 5 years, 6 years, which may take a lot of time. If they feel that they can get easy wins in auditing 1 year, and that will take a shorter time, then they will do that, because then they have a target hanging above their heads and they have to meet it. So we've seen that expeditious reviews, and then a push for quick closure of audits, where they tell you if you don't respond within this time, then we are going to issue a management letter on this date, because we have an internal date to meet on when this audit has to be closed. So especially now, for example, in Uganda, when they start an audit, they have internal dates that an audit started maybe in this quarter of the financial year shouldn't go in the other quarter. So it will even force them to close the audit, despite of the fact that it may be a bit not yet ready for closure, but then they will close so that they can meet that. Of course, once they are closing in such a way, the person losing there, even if they are also losing revenue at some point, if they are taking more time, but the person who loses immediately is the taxpayer, because then they suffer a lot of excessive taxes and also unsupported assessments. Now, after looking at all these scenarios, the coercive measures, the mistakes that businesses are making, and how tax authorities are becoming aggressive in audits and information requests, what should businesses do to prepare themselves for these kind of audits and engagements, and also checks by the revenue authorities? One of the things to consider first is to ensure that businesses tighten up their in-house teams. The person that does your VAT filing, your withholding tax filing, the person that reconciles your monthly payroll, among others, should really be at the standard of looking out for each and everything that can be an exposure to the business. This can also be engaging in trainings, refresher trainings organized by providers, online trainings, trainings on LinkedIn, among others, just to equip themselves with what is happening globally, how they can enhance their skills, among others. They also need to involve external advisors where possible. If at all you receive maybe a request for information, it's better that at that point in time, you involve your external advisor. Could be a lawyer, could be, your accountant, among others. In addition to your internal team, you may want to engage that person so that they get on board with the process at the beginning and they can help here and there. Businesses also need to, where you're not really so much conversant with a certain area, if possible, seek for private ruling so that the tax authority can guide you through the tax implications of your intended transactions. You need to ensure that you reconcile, if possible, or quarterly, but the best would even be on a monthly, so that you know that your matters are tightened up. And even if the tax authorities to come up, you may really have no exposure, or in the worst case scenario, a very, very minimal exposure, because you have been reconciling your declarations on a monthly, your payrolls, your VAT, with the holding tax, among others. Also try to ensure that you keep a good relationship with the tax authority. They are also people. They have targets and all that. By the end of the day, they are people. So try to ensure that you keep a very good relationship. Especially, you could utilize your client relationship manager, so that then even when something comes up, maybe you can get a favor in asking for additional time for you to respond to a query or a request for information, among others. That may come in handy, and you may not actually know the difference it may make in your business when you are having certain maybe kind of a checks by the tax authority. Businesses may also consider utilizing the available reliefs. Some countries now have given reliefs and amnesties. If you declare the principal liabilities within a certain point of time, then you can be forgiven on matters of interest and penalties. So you can also utilize some of those, among others. Then my last session in a minute, Gabriel, I know time is up. In just a minute now, for us, the lawyers and tax advisors advising these businesses, we have to keep learning. Try to be ahead of your client. You don't really want a client to onboard you, but then the client is the one guiding you. Try to do a thorough review of what the client has and the request from the tax authority. Don't take anything as gospel truth, because it is your client telling you. Try to engage early with the revenue authorities. Keep a very good relationship, because again, it is not your case. And sometimes what can only help is that middle person who can at least, bring these people together on a table to discuss when they can't discuss between themselves. So there are quite many, but because of time, I really want to stop here so that then we can also have other discussions and engage in other sharing. So thank you very much for listening. That's all from me. Thank you, Gabriel. Back to you.
Thank you, Fahad, for that very wonderful presentation. As we've had many tax disputes begin long before a notice of assessment is even issued, they arise from compliance failures, documentation gaps, misunderstanding, legal obligations, or disagreements regarding interpretation. And you've well put it, Fahad. I look forward to receiving your notes so that I can personally partake of these insights, but also share the same with our participants who have done an excellent job of keeping through the session till about now. And as we naturally now evolve to our final and very important speaker, who will focus on dispute resolution and enforcement, I am delighted to introduce Mr. Dieudonné, who is a partner at ENS Rwanda, a very highly respectable practitioner in tax advisory and dispute resolution. Dieudonné will help us understand how taxpayers and advisors should respond when tax disputes arise and how best to navigate audits, objections, appeals, and enforcement proceedings. His segment is titled Tax Penalties, Dispute Resolution, and Navigating Revenue Authority Audits under a new framework. Dieudonné, the floor is all yours. I don't know if we can use 10 to 15 minutes and then take a couple of questions. We have some good questions in our chat room, and also try to wrap up the session. Dieudonné, over to you, sir.
Thanks, Gabi. So I think I'll try to be as brief as possible. I mean, appreciating that the time is not on our side. Now, given that this conversation is being held within the context of upcoming finance bills or approval of state budgets across ES partner states, so I think it's good to relate this topic to the upcoming new financial year, which is 2026-2027, and of course, then try to shed some light on the changes that have been introduced in Rwanda within that specific context. Now, maybe as like a side thing, in Rwanda we don't have finance bills in the same way, in countries like Kenya. So we don't have like the state finance law or the budget law, which would, set out, the details about, government revenue and expenses in a particular fiscal year, and where funds are expected to come from and how they are going to be allocated, specifying the key project. But much as that's how things work here. So at least in Rwanda, over the last month, we've had a few legal reforms which are supposed to respond to, or maybe to talk to revenue, domestic revenue mobilization, and eventually funding the government, expenses. The main legal development, leads to the introduction of, the rolling out of value-added tax on digital supplies, particularly business to customer transaction, because as the first speaker indicated, this has never been an issue for B2B transactions. There's also introduction of the new transfer pricing rules with different features, but the main one, a new one being a detailed framework for advance pricing agreement, and this is really relevant to tax dispute resolution. And also another thing which is expected to be effective from 1st July 2026 is the phasing out of the VAT exemption on manufacturers for equipment, raw materials, and other inputs, because this was provided for under the 2025 VAT law amendment, and it was clear that this exemption would cease to exist with effect from July 1st, 2026. Now, back to the main topic of the day, which is tax dispute resolution, of course, within this particular context of upcoming state finance laws. In Rwanda, there is no particular change or new laws to be introduced, at least regarding tax administration. But that being said, in all cases, in one way or the other, the state finance laws or budget laws are supposed to affect dispute resolution, and so is the case here in Rwanda. If we can quick look at the figures, the numbers. So the Minister of Finance early this month presented the budget framework paper, and the 2026-2027 budget is estimated at 7.7 trillion, which increased from 7, which represents an increase of 8 billion, because last year's budget was 6.9 trillion, and 4.4, which is basically more than 50%, is going to be tax revenue. So, and what does this mean then, to the tax dispute resolution? This simply means that the tax administration, be it in Rwanda or across the region, are expected to multiply their efforts in collecting, taxes, and this would include, tax audits, including the targeted one, maybe on multinationals or the usual suspects, quote unquote. And the time we start to talk about tax audit, then the tax disputes also, the tax dispute resolution also comes into play. Now, what we can maybe expect to see in this specific case, so is I don't know whether aggressiveness is the right word to use, but definitely we are going to see a lot of efforts on the side of the tax administration aimed at collecting taxes, at least to meet these, targets as per the budget. And of course, we can see certain areas being focused on, at least based on our past experience, including cross-border transaction, withholding tax, and the reverse VAT. While we're still on this reverse VAT aspect, for your information, in Rwanda, imported services, value-added tax credits on imported services is only allowed when the services are not local available, and sometimes maybe in the context of intra-group transactions, this tend to be ignored, and you end up, claiming VAT without having tested whether the services were local available or not, leading to fines and penalties if it is, the input credit is denied by the revenue authority, at the time of the audit. So we expect also to be a lot of transfer pricing audits. And again, on this one, there has been a shift, and this will continue, where the tax administration is not just focusing on the pricing of transactions, but also the delineation, or to use the layman's verbiage, the characterization of transactions. So, which is very important in transfer pricing, because in the past, many people have tended to understand this as the pricing of a transaction at arm's length. But, the way you decide to delineate, or the way you call the transaction, is actually becoming very important. And as you can imagine, if a transaction has been characterized as a supply of equipment and the tax administration delineates it as a provision of service, you understand what it means from a tax perspective, where I would be in a situation where withholding tax has to be paid, things like that. Now, another area of focus, I think, which has also been alluded to by by Kizito, is the entitlement to treaty benefits. Historically, we used to situations where by being, incorporated or a resident in a contracting state, you will be automatically entitled to treaty benefits. But things are changing. So tax administrations, including Rwanda, in Rwanda, are subjecting the entitlement to treaty benefit to what we call economic substance requirements. And this is very controversial because, and it's one of the areas where there'll be a lot of dispute, because the DTAs that were signed before the base erosion and profit shifting project, that's basically before 2016 or 2017, they didn't include anything about economic substance, anti-avoidance, or anti-treaty shopping provisions. The only thing that was there is beneficial ownership. But despite this, the tax administration, at least in our case, has been trying to invoke this, even in the context of the DTAs that were signed before BEPS. And what does that mean? At least for Rwanda, which has not signed the multilateral instrument to amend existing DTAs, so we can see a lot of disputes, coming up in relation to this specific, aspect. But in all cases, the taxpayers can do something, or maybe the advisors, to manage or to avoid tax disputes. And as I think Kizito mentioned earlier on, tax disputes can be avoided, managed at the time of the transaction, because that's the best way of dealing with it. And in this specific case, the taxpayers need to have robust documentation in place to support their transactions. Otherwise, when the tax administration knocks your door for audit, you can be procedural compliant, respond to their notices on time, but when you don't have the relevant supporting document, so your goose is cooked. So another thing that need to be done by the taxpayers and tax advisors is to tap into the dispute resolution mechanisms that have been put in place. Well, you can think of not even dispute resolution, actually dispute management or avoidance and resolution mechanisms, including the adverse pricing agreements. And this is one of the recent development in Rwanda, where I think it's around the end of the month of April this year, the detailed framework for adverse pricing agreement was gazetted. So this is something the taxpayers, especially those involved in cross-border transactions with related parties, should tap into. There's also adverse tax loadings, because this is also supposed to give a certain level of certainty, and eventually mutual agreement procedure, especially for transaction, for taxpayers, for transactions involving two different tax jurisdictions, and double tax agreement exists between those jurisdictions. Another thing very important here, it's in relation to the management of actual dispute, especially when an audit has been commenced and you are accompanying your client in the engagement of the revenue authority. So there is a need to be very careful about the sharing of information with tax administration, because we have had cases where a taxpayer will be requested to provide a certain document to the tax administration, and for some reason they feel like they shouldn't do that. And when the documents are not shared, one, there may be tax implications, because, for instance, under our tax procedure law, if you don't share a document in support of a related party transaction, the penalty is a percentage of the value of the related party the controlled transaction. And you can imagine how hefty that can be, given the amount involved in certain controlled transaction. But not even just that. If a document is not provided during the audit, you cannot adduce it even at any other level, be it in court or in appeal, unless you prove that you did not have access to that document. So, and we've had cases where you realize that the document was not shared out of negligence, I would say. So, and that's something that really need to be, dealt with properly, when you're assisting or advising a taxpayer, in a tax dispute. So otherwise, for the case of Rwanda, there has not been a lot of changes affecting the tax administration. So the applicable timelines for appeals, taking matters to court remain the same, nothing have changed. And the fines and penalties remain the same. So I don't think there is much to talk about that. So those are my few points. You know, I thought I should share in this specific case. So I think I can hand over. I can hand back to you for you to keep, you know, moderating the question.
Yeah, thank you so much, Dieudonné, for that very perfectly and wonderfully put session. It's really been a rich one, and I see our time is already fast spent. It's already 4 p.m. and I would like to take this opportunity to thank all our speakers for those very rich and insightful questions. I had prepared some questions, but I've already seen the questions from the audience, and to save on time and for the sake of being fair, I would like to probably put the questions asked in the Q&A segment to you, our panelists, so that you can respond. And the first one is, what is the royalty approach to taxation? I don't know, Solomon, if you can answer this question. A participant called Mohammed Abdi Kadir is asking what the royalty approach to taxation is. Okay, any participant, rather any panelist that would like to take this on? We have another question that asks from
the question is about the reality.
Yes, royalty, yes, approach to taxation.
Yes, royalty is a benefit for use intellectual property, patient software, and brands usually, and according to Somali law, royalty is under the 2025 income tax law. Is taxed at a flat rate of 18% for non-residents and the resident rate for normal corporate practice. And withholding 5% applies at the source of Somali per contract foreign royalty service. That's 5% of sales tax. Yeah, and
well,
maybe if I can add something on that, and to put it into context in which this presentation was made. So, as Dr. Abdul Wahid mentioned, so the term royalty used to, is international defenders the use of the right to use payment for right to use intellectual property, right? And there have been controversies around the world, I think starting from India, then in Kenya, as to whether the payment for software constitutes royalty, right? So, and the question became whether a software is intellectual property, and the answer was no, because the software is a copyrighted product. It's in the same way as you buy a book, right? But the book itself is not it's not an intellectual property. The intellectual property is what's in the book, right? So or maybe the right the author to the book has to multiply it or not, right? So that, I think the case in India was decided in favor of the taxpayer. The next case in Kenya was also decided in favor of the taxpayer. So, and I think that's why the governments are trying to bridge this gap, right? To make sure that softwares are also included in the definition of loyalty, right? So that payment for softwares would be subject to withholding tax in the same way as the right to, other rights to use intellectual property.
Thank you.
Like trademarks, patent, trade secrets, something like that. Yeah.
All right. Thank you, Dieudonné and Prof. Looks like we've overstretched our webinar timing. And maybe as we part it up, I will share these questions with you on email and probably have you respond to them so that we can get back to our participants. But as we bring it to a close, I would like to get parting shots from each one and every one of you on how you see the landscape of taxation going forward in 2026, 27, and 28. What are those things that you predict the future could be seeing? I'll start with you, Dieudonné, as we wind up, and your parting shots as well.
No, I'm not sure about the question.
Well, I am asking about your
But you had
parting shot.
concluded.
As we wind up the session, and where you see the taxation landscape going forward through the year and to 2027. Yes.
Okay, sure. I mean, the general trend is that all the tax, I mean, all ES partner states need to have like a fair share of their budgets, supported or financed by their domestic revenue, right? And this means that we need to expect a lot to happen on the tax front, be it in terms of tax collection measures, closing loopholes in the laws, which have been, affecting the government's ability to raise taxes. I think those are the kind of things we should expect in the next financial year. Thank you.
All right, thank you, Dieudonné.
I want to add just a little bit about because I can add.
Yes, Doc, please. Your parting
Okay.
shots as well. Yeah.
One of the very important thing is to expand withholding tax on cross-border digital service, payer labor responsibility, and also the regional EEC custom valuation must be harmonized to reduce the tariff arbitrage that boosts data sharing. Also, one of the other thing is the gradual introduction of modest digital taxi to capture foreign platform revenue. The other thing is, I think, is trade negotiation with additional African partners, not only EC countries, and also the double taxation relief mechanism. It has to be improved. The other main thing that the capacity building to drive faster dispute resolution window and clear penalty regime, because that is some of the future thing that it can be expanded, it can be done. It's being done.
All right. Thank you, Doc. Over to you, Solomon, your parting shots. Solomon, if you're trying to speak, we cannot hear you. Okay, maybe we'll hear from Mr. Gift Luate. Your parting shots as we bring it to a wrap.
Okay, thank you. This has been a very interesting session. My parting shot, in the context of the growing trend in South Sudan, I foresee that there may most certainly be a introduction of a VAT tax, because it's something that long has been under the way, being discussed at the revenue authority level, but also since the other countries are moving towards tax on digital services, most certainly South Sudan will also be looking towards that. But also, finally, the tax authority may most certainly, because of the fall in the revenue collections, come out aggressively to ensure enforcement of tax collections in the country. Over to you.
Thank you, Gift. And finally, to you, Fahad, from a compliance angle, your parting shot, sir. Fahad, you're muted.
Thank you. Thank you very much, Gabriel, and my fellow panelists, as well as the organizers for this session and the attendants. We really appreciate all your efforts. My parting shot would be that the pressure is becoming a bit quite too much across the East African region. for meeting the revenue budgets, the targets, among others. So, and the best strategy is always compliance. So compliance should just actually become our shield and our sword. It should shield us against such kind of pressures, but also it can be the sword that we have to go into that fight with. Other than that, then we become a bit exposed to a lot of those kind of pressures. So let us just be compliant to the best extent possible. We shall enjoy the fare that we can get from the economies. Thank you.
On that point, we shall enjoy the fare that we shall get. I would like to extend my sincere appreciation to you all, distinguished speakers, for your generosity in sharing your expertise and practical insights. Today's session, friends, has demonstrated one thing, that finance bills 2026 and 2027 are about far more than the legislative amendments that we see. We are seeing a reflection of broader shifts in how governments regulate economic activity, how they mobilize revenue, approach compliance, and respond to an increasingly digital and interconnected economy. And as for us all as practitioners, I think the message is clear. We need to do more than understanding the law. We must understand its implementation, enforcement trends, and also share experiences from across the region. On behalf of the East Africa Law Society, our leadership, I would like to thank all participants for joining us this afternoon and for contributing in this very highly insightful conversation. To you, Dr. Abdiwahid, Mr. Solomon Rukunda, Diodone, Gift, Fahad, you've been an amazing, amazing panel. We look forward to hosting you again and again, and hopefully, now that it's officially out, the East Africa Law Society annual conference is happening this year in the beautiful island of Zanzibar. We hope to host you all for a wonderful panel discussion around the area of taxation, and look forward to your participation. Please, when we call upon you, I pray that you will be able to join us for those convenings. Now, as we come to an end, this Thursday, we have a very wonderful session on climate change, and we'll be discussing emerging trends therein, and you do not want to miss that conversation. From us at the Secretariat to you all, we would like to wish you all a very wonderful afternoon, and till we meet again on Thursday, wish you a very blessed day ahead of you. Thank you and goodbye. Recording will be shared with you on email alongside any presentations that have been shared with us all. So wishing you all a very lovely afternoon until we speak again. Goodbye.
Bye.